now it gives me just a tremendous pleasure to invite one of FMA's founders, founder of the Z-Score, and he's going to give a retrospective on the Z-Score, but he's also going to give a forward view on COVID and the credit cycle and what's happening now. So from history to the current, it's really an honor for me to introduce Ed and welcome Ed. He is a co-author, someone whose work we all have admired tremendously over the years. He is the Max Heine Professor of Finance, Emeritus at the Stern School of Business at NYU. He's Director of Research in Credit and Debt Markets at NYU Salomon Center for the Study of Financial Institutions. Ed is an international expert and known very well for all his work on corporate bankruptcy, high-yield bonds, distressed debt, and credit risk analysis. He is the creator of the world-famous Altman-Z-Score model for bankruptcy prediction of companies globally. And he's received so many different awards. His contributions have been recognized. He was the Laureate 1984, announced by the HEC Foundation, the Graham and Dodd Scroll for 1985 by the Financial Analysts Federation. He's an Honorary Professor, University of Buenos Aires, Honorary Doctorate from Lund University, Sweden, and from the Warsaw School of Economics in Poland. He has been advisor to so many different central banks. He is the chairman of the Academic Advisory Council of the Turnaround Management Association. He was inducted into Fixed Income Analysts Society Hall of Fame. He has been a president of the Financial Management Association. He has been an FMA, he is an FMA Fellow, and was one of the inaugural inductees into the Turnaround Management Association's Hall of Fame. He has been named one of the 100 most influential people in finance. Ed, we are delighted to welcome you, and it's all yours. Thank you.
Thank you so much, Rena. What a fabulous president for the 50th year for the FMA. And let me tell you what a great honor it is to be selected to give the 50th anniversary commemorative address for many, many reasons. First of all, I should mention that, believe it or not, I was an original member of the FMA back in 1970 when we were formed. And there's so many people who I've noticed over the years have made incredible contributions. It's really people that determine the longevity and the success of organizations. Yes, there has to be a great theme, there has to be a great following, but without the people and their continuity and commitment, people like Bob Johnson, the original president, Gene Brigham, my professor from UCLA, Jack Rader, who unfortunately is not here, Karen Wright, the guiding light for so many years, Michelle Louis, the current executive director. So thank you all so much, and for the great honor to be with you today. And congratulations also to those winners of the fabulous awards earlier. I'm going to share the screen now, if I would. Okay, all right. Great. So the theme today, as Rena pointed out, is a 50-year retrospective on Z-Score and what have we learned, and with some time remaining, hopefully, COVID-19 and the credit cycle. I must tell you that latter subject needs a full 45 minutes to talk about itself, so we'll only hit the highlights. So fasten your safety belts as we go through this 50-year journey plus together. Let me take you quickly through a long history of scoring systems in the credit space. Back in the 1800s, qualitative factors dominated. We didn't have good databases. We had no databases. We didn't have financial statements to speak of, etc. Back in the early 20th century, with the advent of credit rating agencies, Moody's, S&P, and later Fitch, the big ones, and now others, we had univariate techniques, individual ratios, and later market value estimates from a number of people like Bill Beaver and his publications. I was very fortunate to be the first multivariate market model creator, et cetera, in 1968, as Rena mentioned, the Z-score. And we used a discriminant analysis. There have been many other statistical techniques, logit, probit, nonlinear, linear models, black box models, at least that's what we used to call them. I had the pleasure of doing a recursive partitioning, some neural network work. Machine learning now is a hot buzzword. All of these techniques, of course, are to predict distress, default, bankruptcy, and losses for lenders in these markets, including consumers, manufacturing firms, which was my original model, extensions to industries, a Zeta model I built in '77 at the advent of, I'm talking about a different journal called the Journal of Banking and Finance, which we started in 1977. Private firm models, emerging market scoring models, bank specialized systems, certainly with the BIS, and more recently, for me anyway, an exploration into small and medium-sized firm analysis. Scoring systems included some original work from Robert Merton in the option contingent claim areas, very popular among academics and some practitioners. The KMV is the commercialized version of that, which was eventually sold to Moody's. Expert systems, neural networks, machine learning, as I mentioned, and the flavor of the day is what's called blended models, combining ratios, market value measures, macroeconomic, and now delving again into the qualitative areas, governance factors, artificial intelligence, social media, and all sorts of databases that can help in the accurate fundamental analysis combined with a more modern analysis to predict financial distress of companies. In my own development, the Z-score family of models, let me tell you what it was like doing research in corporate finance in distress prediction back in the 1960s, the Stone Age, if you will, of empirical financial analysis. I was extremely lucky, and I mean this sincerely, to be in the right place at the right time on the UCLA campus or any other campus at that time, where mainframe computers became available for social science research. In addition, I happen to have some great faculty mentors who helped me in choosing the right statistical technique. I chose discriminant analysis, regressions, and later on logistic analysis became more commonly used. There were no databases then. If you wanted to do empirical research, you had to go to the source, gather the data, write it down, transform it onto punch cards. Some of you may remember, if you have enough gray hair or maybe no hair, that there was such a thing called punch cards. And you put that in a box with the source program, quite heavy, so it was good for bodybuilding. And you went across the campus and delivered your box to the mainframe computer people. And then you prayed that you got research and that you got results. And the next day, sometimes you did, sometimes you didn't. And each time you wanted to try a different model, you had to have a different box. That's what it was like back then. But you know, it worked, and it was much better than handheld calculators, abacus, or whatever you needed to use before to do these kind of statistical data analysis. The original model, by the way, I'm convinced that if I had been a student 2 years earlier, I wouldn't have had the computer power to build my first model. And 2 years later, someone else, Rena, would have probably built it. So I'm really very fortunate to be there at the right place at the right time, more than 50 years ago. And by the way, the model is still around. As many of you know, it's still being taught in classrooms like your own. It's in textbooks, and it probably is the most used among practitioners out there. 3 reasons. 1, it's simple. 2, it still works pretty well, 80 to 90% accuracy in bankruptcy prediction within 2 years. And 3, it's free. And you know, if you don't have to pay for something, you'll try it, you'll get rid of it if you don't like it, and keep it if you do. The original Z-Score model were manufacturing firms, publicly owned companies, control non-sample of healthy firms matched by year, size, and sector, and the sample size, believe it or not, was tiny. In those days, however, it was almost the full population. Today, I'm going to show you how many big firms go bankrupt in the United States. Take a guess. This year, 2020, how many billion-dollar bankruptcies are there in the United States today? If your answer was 53, you'd be correct. The highest year prior to this was 2009, when it was 49. So we've already broken the record after 3/4 of this year. And indeed, I'm thinking there's going to be a second wave of bankruptcies. I'll get into that when I talk about COVID-19 and the credit cycle. And we're going to talk about various ways of classifying firms. So the original model was published in 68, later 77. A big jump in our analysis was going from a scoring model to a probability of default model. There are other techniques to do this, but I selected a mortality rate approach, just like an insurance actuarial approach is used for setting life insurance premiums. And we're going to talk about cumulative default and loss distributions, timing of the default from original issuance, and the concept of bond rating equivalence. Here are the standard nomenclature that are very useful for categorizing credit risk of companies from credit rating agencies. Investment grade, non-investment grade, you're all familiar with that. Okay, let's go back memory lane now to the original Z model. 5 variables representing liquidity, cumulative profitability, less dividends, earnings on assets, market value of equity. We were the first to introduce the market value of equity as a measure of credit risk. Prior to this point, and indeed used today extensively, is the book value of equity, but we decided market value had more information content relative to the book value of liabilities and sales to assets. These 5 variables, with their coefficients or weightings determined by a discriminant computer algorithm, help to determine the original Z model. I want to emphasize, this is not an optimal model. You can do better with better data, but we didn't have better data back then. We didn't have cash flow data, for example, and some of the data was questionable. And so we used what we could from these big, enormous Moody's industrial manuals, gathered the data, put it on punch cards, etc. And I, of course, had to clean the data as well. Back in 1968, when we published the piece, keep in mind that the reader was unfamiliar with scoring models. So we had to give them some guidance as to what the scores meant. And we found that scores above a certain level, like 2.99, were considered safe. We had no bankruptcies within 5 years. Scores below 1.8 was considered distress. And these cutoff scores, these zones, believe it or not, have lasted until today. Unfortunately, I say this because no longer are these zones appropriate. I want to repeat that. If you use our model, don't use these zones, but it's on the internet. and people follow what was originally wrote. And they still think that if you're below 1.8, you're definitely going to go bankrupt. That's not the case. And let me explain why. First of all, the accuracy of the models were about 95% on the original holdout sample and 80 to 90% ever since, and then down to 70, 80% within 2 years. And here is a time series of the high yield bond market. I was very fortunate to be introduced to this market and asked by Morgan Stanley back in '82 to opine for them whether they should get involved in this new market called junk bonds. To say the least, this market has survived. It's close to $2 trillion today in the US and about $550 billion or euros in Europe. Here is a concept called bond rating equivalence. You take the score and you look at the median level by bond rating. The last time we did this was 2017. We are updating it as we speak. And no longer is 1.8 the panacea for distress. In fact, the average score for a B-rated bond today is 1.65, meaning that that would originally have been in the highly distressed zone. Today, it's the dominant junk bond. Take a guess at what the probability of default is of a B-rated bond, say, for 5 years. I'm going to show you that in a moment, but think about it. 5 years after issuance, B-rated bonds, what percentage of them default? And I'll tell you in a moment. Incidentally, why the original zones are no longer relevant? There's one main reason. Incredible increase in debt in the financial system. There were no junk bonds then. There were no leverage loans. There were no shadow banking to speak of. Today, those markets are huge. Probably in terms of leverage finance in the US, over $4 trillion. And if you add in the shadow banking, it's probably around 5 trillion, because most of those are non-investment grade. So you take these bond rating equivalents, and now we estimate PD and the probability of loss given default. I use the first method, but I've also used the second. Credit scores, bond rating equivalents, using a mortality rate approach, utilize these techniques to estimate marginal and cumulative defaults and losses. The second technique is used by a lot of researchers, including myself. You take a credit score directly into a logit model, and you end up with a 0 to 1 probability of default. But of course, the logistic distribution has to be the appropriate one. Here are the marginal and cumulative default rate and mortality rate equations, the same equations used by actuaries. And here are the results. Looking at data of every bond issued from 1971 to 2019, and we're talking about millions of bonds, and about 3,600 defaults in that period, defaulting issues, we estimate the marginal and cumulative default rates. And you can see, answering that question I asked you earlier, a B-rated bond in the 5th year has about a 28% probability of default, 72% of surviving. And of course, you compound the coupon over that period, and the risk-return trade-off becomes much more favorable than the PD number implies. And adjusting for recoveries, you see that the loss rate for a 5-year bond is around 20% for 5 years. But the cumulative compounded coupon is more than 30%. So you can do a risk-return trade-off for every risk rating for every year after bankruptcy and determine whether or not it makes sense for you, depending on your own risk aversion. Here is a Z double prime score model that I use for non-manufacturers and also emerging market credits. Very similar model, but we use book equity instead of market equity. And here are the bond rating equivalents. Hopefully this PowerPoint presentation will be available to everyone. Here's an example of the difference between the Z-score and the Z double prime score, which is perfect for retailers. Sears Roebuck went bankrupt in 2018. But in 2016, it had a B- bond rating equivalent with the Z-score, but a D, 0 or below rated for the Z double prime score. So I recommend you use Z double prime, again, for non-manufacturers, but you can try Z-score as well. Bloomberg has it. Incidentally, Bloomberg tells me that they get about 5,000 hits per day on the Z-score, per day. And I don't get 1 penny, unfortunately. I could buy a nice dinner even in New York for those prices. Let's talk about applications now. Well, many of them, this list is far too many. I'm going to talk about COVID-19 and briefly at the end. But let's talk about the right-hand side, which is internal uses, either by boards of directors or by individuals. To file or not, the top one on the right-hand side. I think William Shakespeare once said that, whether or not to file for bankruptcy or not. Now, let me give you a really important personal anecdote on that application. Some of you remember back in 2008, we were in a financial crisis. And indeed, a couple of the icon American companies, General Motors and Chrysler, were in deep distress and were seeking a bailout from the US government. I got a call from the ranking minority leader of the House Finance Committee on December 2nd, 2008, asking me if I would testify in Congress as to whether or not GM and Chrysler should be bailed out. Ford wasn't asking for a bailout at that time. And I said, well, how much time do I have? And they said, 3 days. We're having our meeting on the 5th of December. So I agreed, and I immediately called my graduate assistant. We calculated the latest Z-score. This graph shows the Z-scores from 2005 to the present. Notice back in 2008, around the time that I testified, the score was in a negative zone, deep into the distress zone. I was convinced that GM should not be bailed out, should go bankrupt, and that was the best way for them to survive through the restructuring process, Chapter 11 reorganization. Well, I wasn't very popular among the congressmen. They were not interested in the B word, bankruptcy. They were interested in the other B word, bailout, and they voted for the bailout. I thought I was not very popular, but it turned out that if you want to check that testimony on YouTube, you could see that the congressman really didn't understand Chapter 11 and reorganization and all the benefits that you can get on that. Anyway, George Bush, in the last thing he did before he left the presidency, said, okay, we're going to bail out them one more time, and now it's Obama's problem. And it was, but he did a great job in restructuring the auto industry, but it wasn't enough. And GM, the happiest day in my professional life, filed for bankruptcy on June 1st, 2009. Probably the happiest day in my professional life. I was drunk for a week. You know, we have a little tradition of opening up wine, fine wine, whenever there's a big bankruptcy. You know, as a scientist, we need data points. Anyway, let's see what happened. The Z-scores improved to about 1.5, and then slightly has deteriorated since. It's a solvent company today. Its actual rating is BBB-. I don't think it deserves to be BBB-. It still has a lot of problems, but it's nowhere near as sick and distressed as it was in 2008. That was a great example to me of how you can use it. Let me point out to those of you who teach corporate finance that you can use these scores for many other reasons. Lenders, bond investors, advisors, etc. You can look at it in sovereign default risk assessment, and managers can use it themselves to manage a financial turnaround. Let me move to COVID-19. I don't know how much time I have left. I think maybe I have about 5 to 10 minutes, if that's okay.
Sure, Ed, you have
19
plenty
minutes.
of time.
Rena?
Yeah, you have plenty of time, so please go ahead. Yeah, 10 minutes
Okay,
is fine.
thank you so much. I appreciate that. By the way, we wrote a piece called COVID-19 and the Credit Cycle. I'm sorry I didn't submit it to Financial Management, but it was published in the Journal of Credit Risk in June of this year, and we've updated a lot of the data. I believe it's hugely important for us to understand where we were before COVID-19, to understand what's happened since, and also to understand the issue of the credit cycle. So let's talk about where we were before. Before COVID-19, we were clearly in a benign credit cycle. Low default rates, high recoveries, low yield spreads from investors' required rate of return, and tons of liquidity. But were we vulnerable to a downturn? And was a debt bubble beginning to build even before COVID-19? A lot of discussion about the BBB rating growth phenomena and the likelihood of downgrades in the next recession. And finally, the issue of zombies in our economy, walking dead companies, companies artificially kept alive, which is a very real issue in today's market. And then we had the catalyst. It could have been others, but it was the dramatic COVID-19 epidemic, which started in the US, at least became apparent in March of 2020. Clearly, the benign cycle ended and the recession began, according to the NBER, in February of this year. The Fed and congressional actions that took place were remarkable. I'll comment on that. And the subsequent great market rebound in common stocks, in bond prices. And the disconnect between that rebound and the real economy were there from particularly the Fed actions, but also the stimulus packages, unintended consequences, and to revisit the concept of a debt bubble. And finally, what's happened to defaults and bankruptcies and recovery rates in 2020. Here are the 5 variables I look at to determine whether we're in a benign or a stressed credit cycle. And I mentioned them before. This chart is really important to concentrate on what's happened in the past. The blue line represents non-financial corporate debt as a percentage of GDP, kind of like a debt to cash flow ratio for the economy. Notice there were 3 peaks, 90-91, 01-02, and again in 08-09, in this debt to GDP ratio. And every time we had a peak, within the next 12 months, it was followed by a surge, a spike in default rates in the red dotted line. And notice that you had peaks within 12 months of default rates in the high yield market of over 10%. Here, here. And then finally, let's fast forward to the right-hand side. Notice that we're at a new peak, higher, way higher than we've ever been in terms of debt to GDP of non-financial corporates. But we were still in a benign cycle when we hit that peak, or almost a peak, at the end of 2019. And the default rates in the lower right-hand portion were still quite low, around 2%. But they've begun to spike. And we expect at the end of this year, default rates to be somewhere between 7 and 10 or 11%. Clearly in a stress scenario. But this is really instructive. The yellow bars represent recessions. We are blessed in the United States to have many recessions and lots of bankruptcies. So people studying default risk have lots of data. And that's why, by the way, so many young researchers and even some old people like myself are still in this field. In between those yellow recessions, we have benign credit cycles, 7, 7, 4, and the most recent one before COVID was 11 years, the longest ever. Notice that every time we had a spike in the real economy problems, it was followed within a very short period of time by a spike in default rates, although those default rates actually start rising sometimes before the recession. Which is a leading indicator? I'll leave that up to you when you study this graph. Default forecasting. Very quickly, very few people forecast in this area because it's very difficult and challenging. Someone once said, never forecast, but if you do, never put it in writing. But if you do, do it frequently. And indeed, we do. Other people do it frequently. I'm beginning to learn that. Using a mortality, yield spread, and distress ratio technique. Here are some regressions between default rates 1 year out and the yield spread. Positive, very significant. This is the distress ratio, the proportion of high yield bonds greater than 10%. And next year's default rate, again positive, very high R squares. Here are the forecasts under COVID-19. Here are the people who do it. Myself, 4 investment banks, and 4 rating agencies. All of them are essentially saying by the end of 2020 or within 12 months of whenever the forecast is, we're talking about high single digits or low double-digit default rates. Clearly a highly stressed cycle with respect to defaults. And you go 2 years out, we're talking about a cumulative rate of over 20%. And that is clearly distressed. Here are those numbers I mentioned before. Number of Chapter 11s greater than 100 million, 146. Extrapolated number 195 by the end of the year, the highest year ever, 153. Billion-dollar babies, as I call them, on the right-hand side. We're at 51 at the end of September. And the highest year ever before that was 49. So we have already broken the record. Even with the government stimulus. Ironically, number of small companies and personal bankruptcies are down 20%. And that's mainly due to the stimulus, which is now, of course, been gone for some time. And we expect it happening again, probably after the election. But once that goes, and 2021 could see a big second wave of bankruptcies at all levels. Recovery rates. I know it's a lot to talk about. I only got a couple of minutes, but an article we wrote in Journal of Business in 2005 correlated the default rate with recovery rates. Notice those regression lines all show a highly inverse relationship. You have a double whammy, so to speak, when you have high defaults, like in the right-hand side. High default rates and low recoveries, therefore high LGD. And this is very important for bank provisioning and for a number of other expected loss calculations. Last thing I want to talk about are the BBB rated phenomena. Take a look at the phenomenal growth of BBBs. From $500 billion in 2005 outstanding in the US to $3.5 trillion today. That 7 times growth in the lowest investment grade class is very worrying because of the proportion of those that are likely to be downgraded in a downturn. Rating agencies say maximum 10%. I looked at it using Z-score analysis, and we concluded that 35% of BBBs did not deserve BBBs as of the end of 2019, before COVID-19. Now, I know that 35% won't be downgraded, but let's see what's happened. Here's a list of companies some of you recognize: Ford Motor Company, Occidental Petroleum, Delta Airlines, Macy's, Pemex, Marks and Spencer, Rolls-Royce, Royal Caribbean Cruise Lines. every one of them had a Z-score below BBB bond rating equivalent in 2019, and they've all been downgraded. Well over 200 billion so far. We forecast 600 billion by the end of 2021. Maybe we're too high, but there could be a crowding out effect, and that's my major point. Crowding out the lower quality companies in the junk bond area, and there are lots of them, B- and CCCs, crowded out by the funding requirements of these new BBB rated bonds. And let me get to that now in my final comments. Some recent observations. High yield bond new issuance during the pandemic going through the roof. More than $350 billion so far this year through a couple of days ago, up 65% versus 2019. Investment grade new issuance, over 1.5 trillion, up 72%. But corporate bond prices have rebounded to normal during the pandemic, even in a recession. Default rates trending up. Unprecedented support from the US Central Bank. They are now buying corporate bonds, including fallen angels and ETFs, and giving incredible support and confidence. So much confidence that it's risk on during a pandemic. Successful? Absolutely. But with lots, in my opinion, of unintended consequences. Final bullet. Non-financial corporate debt rising to alarming levels again. A debt bubble? Perhaps. I'm concerned. But there is some silver lining out there. Now, let me end my comments by recollecting some corporate finance capital structure issues. Back when I was a student in the 1960s, I was reading people like Ezra Solomon, who probably you've never heard of by now, but he was talking about opportunistic financing, wonderful. And Stuart Myers from MIT and Jim Van Horn from Stanford all talked about these things. Use debt when you can, when interest rates are low. And that's what's happening today and has happened for several years now. But those debt levels are at such high levels, much higher than most target capital structures. Is there a silver lining potential? Absolutely. And I hope it happens very quickly. Debt buybacks, new equity issues. Start reducing that debt when you can. With that sobering final comment, thank you for your patience, and I turn it back to Rena. And once again, so happy to be involved in the 50th anniversary of the FMA.
Ed, excellent. That was such an amazing presentation. So if you don't mind answering a couple of questions that have come in here. Bhavik Parekh asks, how can government bailout programs, which were initiated during the current pandemic, be better captured in Z-score kinds of calculations?
Yeah, that's a great question. And I hesitate to say great because it means that the other questions that came before were not great, but there were no other questions before. So Z-scores, as most of you know, is somewhat backward looking, unless you do pro forma analysis, which of course is very important. So yes, I think what we could do is two things with the Z-scores in this government supported environment we're in. One, we can look at, of course, what was happening even before the bailout and talk about, and that's what I did with the BBBs, and look at what's happening since in terms of downgrades. And by the way, there's a lull in downgrades. There's a lull so far in bankruptcies in the last month and a half or so. And we have to hope that that continues, but I think it's not going to in 2021. The other thing we could do with Z-scores, as I mentioned before, is plug in what might be the new normal with respect to corporate performance. Let's say by, first of all, year-end 2020, 2020, when we expect a drop in GDP of about 3 to 4%, which of course hits different companies in different ways, and certainly into 2021. Are companies in general, if you take a look at aggregation of Z-scores across investment and non-investment grade companies, are they healthier today based on the aggregate Z-score than they were, for example, in past downturns or crises? My expectation is 2021, the average American company will be slightly lower than what it was in 2007, just before the last crisis.
Ed, another question from Kem Harvey. Kem is asking, are there other variables that you would have included or considered back in 1968, knowing what you know now?
Absolutely, Cam. I've said this many times. I wish I had good cash flow data. And the other thing I didn't do then, I wasn't clever enough back then to understand it. I should have included volatility measures, such as not only the level of market value of equity to debt levels, but the variance around the market value of equity, say over the last 3 years for the company. Kind of borrowing, although I guess now it would be borrowing, but it was before, you know, Robert Merton's work and subsequent work using contingent claims analysis, where the variance of market value of equity plays a very important role, as many of you know. So if I had thought about that, and by the way, of course, I would need the historic data to do that. And yes, it was available, but painstakingly to gather then. I would have included those types of variables had I, you know, had that insight back then. I'm surprised, by the way, perhaps more than anyone, that an econometric model built back then is still around and still as accurate as it was, even though there's no question you could build better models today in terms of better variables and a much larger sample.
We won't be able to get through a lot of other questions, but Ed, I do want to ask you one last question here. What advice would you have for scholars working in this area? What are kinds of issues that you think are important that people should be addressing?
Well, that's an interesting question, because I'm still doing research in the area, so I probably should think about that question myself, not only for the young scholars, but for the old guys. Well, certainly, with the huge increase in databases and types of data that's available through machine learning and through social media and whatever, is to incorporate as much as you can now, and we're doing this in some work I'm doing in the SME area, non-quantitative measures, but don't throw out the quantitative ones. Kind of like have a, let me suggest a 3-module approach to scoring models. One, look at fundamental, don't throw out the fundamental of companies, still very important. 2, look at governance factors. Look at, and we can improve upon our measures of governance. Look at social media inputs, but don't get carried away with too much noise. And 3, look at macro data in the sector, in the country, of the companies you are investigating. Blend them together in some way. And that blending, of course, is very tricky depending on the statistical technique that you use, whether it be an enhanced regression type analysis or a machine learning. But here's the other thing to suggest to young researchers. Don't get too carried away with machine learning unless you can explain the results very carefully to practitioners, because they're not going to adopt it unless they're hedge funds and they're simply looking for a comparative advantage. They're not going to accept it in their traditional lending unless they understand it.
Great. Thank you, Ed, for this most fascinating and insightful talk. Look back into history, but also a look into the future. We really appreciate it. I want to take this opportunity to, just like Ed, thank the FMA staff, Karen, Michelle, Shannon. We couldn't have done it without all of you. I want to thank everyone else, the track chairs, the people who chaired best award papers. I want to thank FMA President Jeff Coles for all of his support. It's turning out to be a great conference, even though we are virtual. And I hope everybody continues to keep well. That's the most important thing right now. And I do want to highlight that Professor Michelle Lowry will be our new Vice President for Programs. And I'm sure she's looking forward to having your participation in the program next year. At this point, we don't know what will happen next year at this time in October. Whether we're going to be virtual, in-person, combination, I'm sure we'll be evaluating all of this in the next few months. But thank you all very much, and I hope you enjoy the rest of the conversation. Take care, stay healthy, that's important. And thank you.
Thank you, Rita. You're a great president.
Thank you. Okay, Ed, look forward to seeing you later, and I guess
yeah. Well, thank you for giving me the time. It ended up, I got it all in.
Excellent, excellent, Ed. It was a great talk.
Thank you, appreciate it. And thanks for the invitation.
Absolutely, bye-bye.
Bye-bye.